Understanding inflation and its negative counterpart. Inflation refers to the general rise in prices of goods and services over time. It erodes the value of money. A dollar today buys less tomorrow. Economists measure it through indices like the Consumer Price Index (CPI) or the Producer Price Index (PPI). Deflation, by contrast, is a sustained decline in the general price level. It means that money buys more tomorrow than it does today. While this might sound beneficial, the dynamic it creates in an economy is deeply destabilizing. Consumers delay spending, businesses cut investment, wages fall, and debts become harder to repay. The result is not a virtuous cycle of affordability, but a vicious spiral of contraction. To appreciate why, we must understand the forces that drive both inflation and deflation. Inflation usually results from demand exceeding supply, demand-pull inflation, or rising costs of production, cost-push inflation. Deflation arises when demand collapses, supply gluts flood markets, or credit tightens so severely that money itself becomes scarce. The mechanics of deflation works through several interconnected channels. The most obvious is price decline. When consumers notice that prices are falling, they often postpone purchases. Why buy a car today if it will be cheaper in 6 months? This behavior, replicated across millions of households, reduces demand further, causing companies to cut prices again. Lower revenues push businesses to cut costs. They freeze hiring, lay off workers, or slash wages. Falling incomes reduce consumer spending even more, deepening the cycle. Meanwhile, debts, whether household mortgages or government bonds, become more burdensome in real terms. If wages fall but debt obligations remain fixed, borrowers struggle to keep up, leading to defaults, bankruptcies, and financial instability. Banks become more cautious about lending, further starving the economy of credit. Investment shrinks, innovation stalls, and economies slide into stagnation. This is why economists often describe deflation as a self-reinforcing trap. Historical case study: the Great Depression. The most infamous deflationary episode in modern history was the Great Depression. Beginning with the Wall Street crash of 1929, the United States and much of the world plunged into economic collapse. Between 1929 and 1933, U.S. prices fell by nearly 25%. Wages declined, unemployment soared to 25%, and businesses failed in unprecedented numbers. The deflationary spiral was brutal. As people lost jobs, they cut spending. Falling demand forced prices lower, making it harder for businesses to survive. Farmers saw crop prices collapse, leading to foreclosures. Debts became crushing, leading to widespread defaults. The banking system itself teetered, with thousands of banks failing. It took massive government intervention, public works programs, financial reforms, and ultimately the mobilization of World War II to pull economies out of the deflationary abyss. The Great Depression remains a stark reminder that deflation is not benign, but catastrophic. Japan's lost decades. Another cautionary tale is Japan, which endured prolonged deflation from the 1990s onward. Following an asset bubble in the 1980s, Japan's real estate and stock markets collapsed. Banks were saddled with bad loans, consumer confidence eroded, and prices began to stagnate and fall. For decades, Japan struggled with near-zero or negative inflation. Economic growth slowed, wages stagnated, and an entire generation grew accustomed to an economy where deflation was the norm. Efforts to reflate the economy through monetary easing, fiscal stimulus, and structural reforms had limited success. While Japan avoided the outright collapse of the Great Depression, its experience shows how deflation can sap dynamism and create long-term malaise. The global financial crisis and the fear of deflation. In 2008, as financial markets collapsed and demand evaporated, the specter of deflation haunted the world again. Prices briefly turned negative in many advanced economies. Central banks responded with unprecedented measures, slashing interest rates to near zero, injecting liquidity through quantitative easing, and guaranteeing banks to prevent systemic collapse. The fear of deflation drove these extraordinary interventions. Policymakers remembered the lessons of the 1930s and Japan's stagnation. Better to risk higher inflation later, they reasoned, than to allow economies to slide into deflationary spirals. Why deflation is dangerous? The dangers of deflation are multifaceted. At the household level, deflation punishes debtors. Mortgages, student loans, and credit card debts become harder to repay as incomes fall and the value of money rises. Homeowners risk foreclosure, students face crushing burdens, and businesses collapse under obligations that once seemed manageable. At the corporate level, falling revenues discourage investment. Why build a factory or launch a new product if future prices will be lower? Innovation slows, productivity stagnates, and growth disappears. At the macroeconomic level, deflation can paralyze monetary policy. Central banks cut interest rates to stimulate demand, but rates cannot fall below zero easily without creating distortions. When deflation is entrenched, even zero interest rates may not encourage spending. This scenario, known as a liquidity trap, leaves policymakers with limited tools. The social and political consequences. Deflation does not remain confined to balance sheets and GDP statistics. It reshapes societies. During the Great Depression, deflation coincided with mass unemployment, widespread poverty, and the rise of political extremism. Economic despair fueled movements that challenged democratic institutions and reshaped global politics. In Japan, deflation produced a quieter but profound shift. An entire generation grew accustomed to low expectations, cautious spending, and risk aversion. Entrepreneurship suffered, and young workers entered labor markets where opportunities seemed perpetually limited. Deflation can create not just economic stagnation, but cultural resignation. Could deflation ever be beneficial? Some argue that deflation might have positive aspects. In industries driven by technology, falling prices are often the result of innovation. Consider personal computers or smartphones. Each generation offers more power at lower cost. This kind of good deflation is supply-driven, reflecting productivity gains rather than demand collapse. Consumers benefit and economies continue to grow. The danger lies in broad-based, sustained deflation across an economy. When falling prices spread beyond isolated sectors into wages, housing, and general goods, the harmful dynamics dominate. Economists thus distinguish between benign deflation from innovation and malignant deflation from economic weakness. Policy responses to deflation. When inflation goes negative, policymakers reach for a range of tools. Central banks cut interest rates, sometimes even experimenting with negative rates to encourage borrowing and spending. They engage in quantitative easing, purchasing government bonds and other assets to inject money into the system. Governments deploy fiscal stimulus, funding infrastructure, social programs, or tax cuts to boost demand. Some propose more radical measures: direct transfers of money to households, helicopter money, higher inflation targets to create buffers, or structural reforms to boost productivity and wages. The key is to break the cycle of falling prices and collapsing demand before it becomes self-reinforcing. Deflation in the modern world. The risk of deflation has not vanished. In the wake of the COVID-19 pandemic, central banks worried about demand shocks creating deflation, though massive fiscal and monetary interventions instead fueled inflation. Still, deflationary pressures lurk in aging populations, technological disruptions, and global competition. If demand falters or financial crises return, the specter of deflation could rise again. Climate change, too, presents complex risks. Severe weather events may cause supply shocks, while transitions to green energy could create demand uncertainties. In such contexts, inflation and deflation pressures might coexist, complicating policy further. What happens if inflation goes negative? Far from being a windfall of cheaper goods, deflation threatens the foundations of modern economies. It discourages spending, punishes debtors, weakens investment, and undermines growth. History shows that deflation is associated not with prosperity, but with depression, stagnation, and social turmoil. While limited deflation in specific sectors driven by innovation may benefit consumers, broad-based deflation across an economy is a trap to be avoided at all costs. Policymakers treat it with urgency because once entrenched, it is extraordinarily difficult to reverse. Inflation may erode the value of money, but deflation erodes the very momentum of economies. When prices fall across the board, the future becomes something to wait for rather than invest in, and that waiting drains societies of growth and hope. Deflation explained is deflation feared, and for good reason.